Isn't that interesting?
And that's what our clients do, right? They're both. That's what you guys do, right?
Yes, sir. I'm trying to try to make that.
And now the final of the finalists, Team 5.
Thank you, Chris. Do you mind clicking share?
Yeah.
Okay. Good afternoon, and thank you for joining us for our presentation. Today we'll examine the various options available to Quartet Development as it evaluates its strategic direction, something we like to call Quartet's Quandary. Our presentation today is split into two components, strategy and opportunities. First, we'll evaluate the current strategy and provide our recommendations for revisions to that strategy, and we'll also look at some internal metrics on Quartet. The opportunities section of our presentation examines the Calgary land development opportunity and also looks at a high-level review of Saskatchewan and Edmonton opportunities. As we look at Quartet's current strategy, they're trying to find the balance between long window, capital-intense land development and short-term, lower-return home building. And after 25 years, it's hard to say, but there is no clear strategy. 1/3 of developable land comes from internal sources, 1/3 is purchased, and 1/3 comes from equity partnerships. Without a consistent strategy, it's led to volatile returns, income returns going from 14.8% in 2011 to 6.7% in 2013 and back up to 9.1% in 2015. We believe the volatility in these returns is a result of unsteady equity land partnerships and increasing land and construction costs that have not been offset by revenue increases. As the Alberta housing market faces uncertainty, now is a great time for Quartet to revisit its strategy and, most importantly, its capital structure. Historically, the company has primarily completed projects using internal capital. This reliance on internal capital has limited their ability to realize upon opportunities as they become available. The majority of equity is actually tied up in WIP and inventory. And the days in inventory has gone from 225 in 2011 to 301 in 2015. This highlights the fact that while equity is tied up in these assets, they are not able to mobilize on great opportunities as they become available. And we'll explore that later in the Calgary land development. I'll now pass it off to my partner, who's going to talk about how we're going to revise this strategy.
You got to push it to the end. Okay, so looking forward here, we're looking at our new revised strategy, and how we're going to do that is really take a vertically integrated approach. Investors must be prepared to be patient when looking for returns. This strategy is much more capital intensive. And what we're going to do here is we're going to launch a new fund that will allow Quartet to mitigate risk, reduce their equity exposure, and maintain the current ownership structure. Next slide. Looking at the process, the launch of the GCA fund will allow investors to take part in land acquisition and residential development. Next slide. When we're looking at long-term investment criteria, we have a number of studies that we need to conduct. One is that we need to ensure that we're close to infrastructure, that we have municipal governments behind us, and that we have schools, community centers, and public transportation adjacent to land that we are looking to acquire. Looking at the internal analysis of the company, you can see on the chart, as my teammate mentioned, there is volatility over the 5-year period. Looking at this 5-year period, we can see that the land development has had a higher return over home building. Home building has had a higher return over land development. What we plan on doing through our vertically integrated process is creating a much more stabilized return that will allow for a streamlined process that can create both home building and land development to be much more consistent. Looking forward over the Calgary development, I'm going to now pass it over to my teammate.
Okay, here's how we're going to apply our strategy
structuring and sourcing the deal, specifically in the Calgary city. From the left side, basically we're gonna suggest Quartet, to acquire the land that build properties on it and sell them more. This arrangement requires an extra $500 million in the left side. To finance this increased part, we're going to pursue a construction loan with less than 50% LTV ratio, which is a rate we believe is profitable to the company and also conservative and secure to the debt holders. Next to the construction loan, the fund we're going to launch will also provide a quarter of the cost we need. And lastly, we're going to finance the project from the proceeds of pre-sale our properties in the future. And although the total cost almost doubled by arranging like this, we do have some external backups to that, so I'm going to pass to Edwin.
Our group first looked at the Calgary market. Although the CMHC report doesn't account for the oil price decline recently, we feel like the market is cyclical and the market will bounce back eventually. It also indicated that there's a short-term decline in multifamily residents, but will eventually normalize. Also, according to Appendix C, the net lot availability will be declining over the next 3 years, but eventually there will be an upward trend. We feel it is important to also look at the other markets in the area. Next is the Edmonton market. They're experiencing historically high migration rates, and the labor market is doing well. The market is also minorly affected by negative economic activity, but it is smaller than the Calgary market. We feel like this is a long-term potential investment opportunity. Next, we looked at Saskatoon and Regina. We feel like they provide a similar story. They're both commodity-based cities, and as the U.S. economy recovers, the housing market and labor market will rise. But it is not a strong market at this time. Overall, between all the cities, we feel like Calgary is the strongest market to invest in, and I'll leave it up to Elvis to wrap up our Calgary project.
Thanks. Based upon all the information available, we broke down the properties into 3 types of property. First, 50% our deliverables will be the single family, and the 30 will be stacked townhouses, and the rest will be smaller single families. And we believe this combination covers a universe market demand and also keeps the leads change to the original plan. And according to our revenue projection, we're going to bring up the return on revenue and the return on cost by 3% and 4% respectively, and which is also a conservative projection because we didn't apply any crazy assumptions on that. And to sum up, we hope that. Okay. Sorry.
Could you complete your summary?
I think you guys are typical developers. You're going big. You took this little land acquisition and turned it into some big, huge fund. So were you planning on rolling in the corporate assets into this fund, or were you just going to do it on land acquisitions?
We're going to keep it a separate entity.
Okay.
And so where does the $200 million of equity come from?
Well, from the case, we saw that there was strong demand from institutional investors and private net worth investors, so we would raise that externally.
You mentioned
we would also apply 30% of Quartet's capital in that fund, so we'd have skin in the game.
You mentioned that investors must be patient. They typically aren't, of course. But I couldn't discern from what you said what the investors will get out of this.
So the fund is a closed-end fund. It will be a 5 to 8 year fund. The return on the fund is expected or projected to be 9 to 12%. Is there anything else?
That's a return on equity?
That's return on equity.
Do you think that's enough?
That's more than patient.
Although the returns overall in this case are low compared to real life. And in this world, probably interest rates are -1, and REITs are yield 2. So it's a great return.
Good point.
That's taking a conservative approach. I mean, our returns on the investment the Calgary investment is much higher.
So what would the return for your client, if you will, be in relation to the return for the investors? I forget the name of the company, but...
Quartet.
Yeah, Quartet. What's Quartet's return as compared to the return provided to the investors?
Quartet is receiving a management fee for managing the fund, as well as receiving a hurdle return based on...
But you have any idea in terms of the relationship? Are they profiting wildly while the investors are just getting 8 to 9%?
No, really, we see the launch of this fund is not more so as a way for Quartet to profit from management fees. We see it as a way for Quartet to mitigate the risk and allow them to invest in opportunities that they would otherwise not be able to invest in.
How would you deal with the conflict between the two? You got a fund on the one hand with other investors, and you have your own business. Like, where does the land? Is Quartet going to buy the land from the fund? Is that how it's going to work?
No, the fund sources the land separately. There's no fiduciary issues concerning Quartet and the fund. They're not going to be acquiring land from Quartet. They'll be acquiring it from an outside source.
Who's the customer for the fund? Like, who are you selling to?
From the case,
Is that with CAI?
Yeah, that's what you... No, CASE.
Are you guys Canadian? Case to default.
No.
So you're just selling land. That's what I was trying to ask, right? Are you selling service lots? Is that what you're doing?
Yeah.
You're developing lots, and who's buying these lots? Would Quartet buy the lots?
Oh, so you're asking about the end user.
Right.
So the end user, we see there could be a variety of different investors in that. So we're opening it to the public.
But would the investors participate in the land development as well as the housing profit? Is that all being done within the closed-end fund?
Yeah, I think we talked a lot about that part, because that was the consideration of if, okay, the land development is a 5 to 8 year window, the home construction is 5 months to a year, and we were talking about doing a phased approach. But yeah, our initial thought was that they would just participate in the land return, but then we also considered what would happen if they participated as well in the home equity or the profits from the home development. But I think at the end of the day, we were looking at it as being a land development fund, and then selling the product through Quartet, so that Quartet would get that vertical integration of doing the land development plus the home construction and the sales to the third parties. But it's an issue we haven't 100% because there was limited information, but we felt more that the kind of investors we were looking for would be land development investors, longer term window, 5 to 8 year return versus that 5-6 months to a year return on the home construction.
We tell them land development and housing is much more profitable now, or wait.
Yeah.
No, you get to use the money many times. I think each of the groups are assuming that you need all the money and you use it once. We rotate. You collect deposits. You don't have to pay for the servicing until. So the amount of capital that's needed for this is a lot less than all the presentations. It's a pretty robust business. I doubt you need as much capital as you guys are using.
Yeah, unlike a lot of people looking for money, you didn't put inflation in your projections. Like a lot of people going out to look for money put inflation, and they say, "Oh, to the sky, it's 5%. Trust me on that point," and that's how they make these numbers look ridiculously high in the returns. You guys are too honest. I think that's the problem.
So you did think about phasing it?
Yeah,
Is
so
that
yeah,
what's
we
usually done?
it may not have reflected in the structure there, but we did talk about doing a phased approach, maybe
Yeah.
500 and 500, because we were worried about supply and oversupply, and so we wanted to make sure we didn't just go out and build 1,500, or I think we had 2,100 units straight away on spec. So we wanted to do a phased approach to the land development. So you are right that I think in our structure here, we may have, the fund itself was looking at the longer term, at the whole horizon, but we may actually do it in tranches. We may not actually go out and say we need, I think we say 200 million straight away. It may be, a 75 million tranche, and then another 75, and then the balance. So that was kind of the approach, was that, yeah, we felt that from deposits and pre-sales, we could also finance the future sales in the project. But for the deal structuring here, this is kind of how we presented it. But there was a phased approach to the project.
When you do this, do you use debt when you're...
So what happens with Quartet at the end of the fund? Because it's going to run out of land.
Yeah, so guys, the plan that we looked at was that there'd be continual opportunities and there'd be future funds. This was just a closed-end fund for this project in this opportunity. We also wanted to look at Edmonton, Saskatchewan, Regina, other projects. The plan long-term for Quartet is that there's a consistent kind of pipeline of land development coming through. So that there's not just this one project and it doesn't just fade away. It's that there's a consistent kind of projects in phase. So I think we looked at, like, if we could have 1 year worth of development always at the ready. Now, I mean, it's difficult because they are transitioning from a strategy where it's kind of a hodgepodge of buying land here, equity partnerships here, to this more integrated strategy with the fund. So there will be that kind of growing pain as they transition through that period. But our hope was that we would look at doing other funds in other markets. And maybe it's in Calgary, but Edmonton looked like another potential market for another fund. So there'd be multiple projects happening at the once. But it's structuring will be a concern.
You referred to volatility as a negative when you talked about how Quartet operates now. How do you take the volatility out of housing?
That's a good question. I think one way we looked at it was through phasing. So when looking at this development, we really wanted to say, okay, are we going to launch and provide 2,000 new units to the market all at once? And how is that going to impact the market? How's that? Is there demand? So phasing, I guess, would be the answer, the short answer.
I only say it because we missed on our third quarter numbers by 50%, and in the fourth quarter we were about 40% above it. So it looks nice, smoothing out construction and housing prices and demand. Looks nice. It's very good.
I can ask one more question. How do you know you're going to get 2,000 approvals from the city?
I mean, this process takes a long time, and we've accounted for that. So we don't know for certain that we will, but we've allotted time for that reason.
So do you have any cash on the purchase price?
Yeah, what's that?
Was it all cash purchase price?
It's time.
Cash, yes. Yeah. Cash on land, yeah.
Thank you.
Good work, guys.
We have one final round of